Radio.
All right, everybody. We're about to get into our final panel for the day, but please be advised we will be opening up our happy hour after this. If you want to go out through the double curtains, we will be opening up that networking happy hour after this session. But if you would be so kind to take a seat and join me in welcoming our next set of panelists. We are welcoming to the stage Richard Carthon, the CEO of cryptocurrent, Ian Balina, CEO of Tokenmetrics, David Chase, the managing partner of Crescent City Capital, Acacia Digital, and Evolve Energy Partners, and Patrick Zielbauer, the director of global sales for Blockfills. So please give me a warm round of applause for them.
All right. Well, it's been a great day. Hope y'all have enjoyed all the great content that we have been sharing, but we're going to finish with a bang. Lots been going on in the market, and a lot of people kind of want to hear some different takes. So as y'all know, this is going to be the panel about smarter trading and things you can be doing into the future. And so I'm Richard Carthon, as Steve said. I'm one of the founders of cryptocurrent, helping to bridge the gap between people who know nothing about the space with the thought leaders and providing solid educational content for that. And we're helping to put on AGMI. Austin's going to make it, and have the pleasure of being on this amazing panel with David, Ian, and Patrick. And I'll let them do a quick little intro of themselves, and we'll go ahead and dive in. David.
All right, sure. So Richard, thanks for putting this together, man. And you did a really good job. Stephen, thank you. So David Chase, so I manage, along with Richard and Hunter, who is here as well, 3 crypto ventures, all working, I believe, very synergistically with each other. Crescent City Capital, which is multi-strategy hedge fund. We launched in late 18, early 19. We have Acacia Digital, which we launched about a year ago, which is early stage VC, early stage blockchain VC fund. And then we have our mining fund. We mine exclusively Bitcoin now, which is Evolve Energy Partners.
All right, good afternoon. I'm Ian Balina, founder and CEO of Tokenmetrics. We're an AI-driven crypto analytics platform, also the partner of Tokenmetrics Ventures, which is a multi-strategy crypto hedge fund and VC fund.
Good afternoon, everybody. My name is Patrick Zielbauer. I am the director of sales for Blockfills. Blockfills is a liquidity and technology provider to institutions in the digital asset space. We provide liquidity in spot, derivative, and lending markets, both over-the-counter and API-driven, and our clients are mainly multi-strategy hedge funds, asset managers, digital banks, exchanges, other OTC desks, payments companies, and other institutions looking to participate in this very exciting space. Thanks for coming.
Awesome. Well, excited to have you all. It's super easy to trade in a bull market. And you pretty much put your money in something, and all of a sudden it goes up. It's a different story when it's a bear market. And we've now been in a bear market basically since the beginning of the year, and it could potentially be extended out. What are things that people can be doing right now to start to plan and be able to be a smarter trader right here in this moment during this bear market? Dave can kick it off.
Okay. When I started trading, 10 years ago, and obviously a lot different markets, there was a saying who I'm sure you guys have all heard, bulls make money, bears make money, pigs get slaughtered. And the idea here is that you obviously don't want to be greedy. So I think that my answer to your question would not necessarily be a directional play. Yes, it is easy to buy something, watch it go up, and have paper money. But it's a lot harder to pull the trigger and to actually sell the asset if you are trading it. It's a different story if this is a long-term play for you. It's part of a balanced portfolio. So my answer would just be don't get greedy. If you see an entire asset class that goes up thousands of % in a year, you might want to take a little bit off the table and monetize those gains.
So the way I view it is, The bear market is the best time to invest in crypto. That's where the best returns, the best value is found. Buy low, sell high. It sounds very basic, but that's how you make money in crypto. And in my opinion, and in my personal experience, all the best investments come in a bear market specifically because the people who are still around now, they're active in crypto. They're here for the long term. Those who came here for the quick gains, the quick profits, the flashy, sexy, making money in crypto, they've left. They've left the building. Now when you go to a crypto conference and it's all developers who are hungry, still building the future of crypto, and they'll sit there with you and talk to you for an hour about their project, not having to compete with other VCs. I mean, to me, this is really a thriving opportunity to make money in crypto.
Well said. The first thing I would say is that if you found yourself in a position where you were attracted to what we saw over the past year, and you did sort of fall into a hole as a result of that, you are definitely not alone as an individual. Our company specializes in providing financial products and trading and hedging solutions to enterprise-level institutions, and they all made the same mistakes. We service a lot of the mining community who have a lot of Bitcoin on their balance sheet, or at one point did. Now they all sell it. They don't hold it anymore because they can't afford to. But we, as a company, we would go to these companies and say, look, the market is red hot. The skew is crazy. You should think about some sort of hedging or downside protection strategy. And no one listened to us. I can't tell you how many times I was laughed out of the room, I mean, figuratively speaking, when I would talk about those sorts of solutions coming from a commodity futures background. So the first thing I would say is that you're not alone. Some really smart people made mistakes in the last year as well. But the other thing I would say is that, in a flat market like what we're seeing lately, don't be afraid to look for, more market neutral solutions to trade. And so we're very active in the options business. I'm sure we'll talk about that a little bit as well, but it's not just always directional. Some of the more successful groups that we interact with are very neutral in their positioning, and some of those tools are starting to become more available to the retail public as well. So market neutral strategies that are not as biased in one direction or the other might be something to consider if you're anticipating the macroeconomic environment to keep the lid on things for a while. So something to think about.
I'm actually going to pass it right back to you because my next question was actually going to be on that. So how do you hedge against all the different risks that is really out there? I mean, obviously there's a ton of FUD that's out there, which is fear, uncertainty, and doubt, and it's going in both directions, right? So we've seen moments where the market all of a sudden, goes from 18,000 all the way up to 22, and you're like, all right, we're back, and then the next day it's right back down, and everyone's saying one thing or another. But how can you start to hedge against some of these risks that are out there? And I know you started to touch on a few of those.
Yeah. So I mean, the strange part about that, the answer to that question right now, is that no one considered counterparty risk to be the main risk in our business up until like 6 months ago. Now counterparty risk is the only thing that we get asked about first. It's counterparty risk and credit. Because again, we are facing more of an institutional client base. But I would say that, going back to the point about the options market, there was a time when Bitcoin was trading over $60,000 where you could theoretically sell a call, $120,000 call, and buy a $48,000 put for no cost. It was referred to as a zero cost collar. It's an extremely common trade in other assets. And when you start to see that kind of risk reward ratio just get so out of bounds, it's time to start thinking about ways to protect yourself without forcing you to necessarily close your position. So again, the over-the-counter options market is not available to the retail public yet. There will come a time where I think it will become more accessible. You have to be a qualified counterparty to interact with us in this way, but it should not prohibit you from at least becoming aware of those strategies and looking, potentially even to domestic regulated exchanges where you might be able to initiate those sorts of transactions, because it is coming. A real derivatives market, an options market, is what feeds the institutional adoption that I think we're going to see for the foreseeable future. So, look for hedging strategies that you can trade around, your core position, so that you don't necessarily have to close out your trades or, incur taxable events and the sorts of things we heard, earlier in the day.
So on the investing side, the way I view hedging risk and investing in crypto you always have to diversify. It sounds very simple, but let's take, for example, Ethereum, right? I'm very bullish on Ethereum. I think it's the future, but you can't put all your eggs in one basket. So you hedge away that risk by saying, if Ethereum were to lose, what's the next potential replacement for that? Whether Solana, Avalanche, Near, and the way we view investing is we always have 3 or 4 different potential winners as a backup. That way, if one goes completely under, Luna, for example, right, you're still alive, right? So for us, we like to hedge both on the investing side in terms of a particular category. Let's say DeFi on Ethereum, DeFi on Avalanche, DeFi on Near, or whatever. And then also other crypto asset classes like NFTs, right? For a moment of time, NFTs weren't really correlated with regular crypto assets. For the first time, we actually had a different category in crypto. So for example, we have legacy markets where we have equity, stocks, which aren't really correlated with art. And for the first time in crypto, during the last bull run, the same thing was happening with NFTs. There was a period of about 6 months or more where NFTs were going up as crypto was going down, or ETH was going down. And that was a good way to hedge away that risk. So we like to go through different asset classes, different categories inside of crypto, and see how we can mitigate that risk by hedging and putting assets in other places.
So I'm going to hit on three points that have kind of been touched on. One, I'll be brief because it unfortunately is not available for retail, but our most volume at Crescent City over the last 6 months has been in the options market. The collars that Patrick was talking about are a big strategy for us. It allows us to hold, on both sides. We can hold cash on our books while still having, potential call upside and selling puts. So that I think, and I agree, I think that that's coming for the retail world, and I think that that's going to be the best hedging strategy. The second thing that I'll say is something that hasn't really been touched on too much, but I think that everybody needs to realize their taxable losses this year. If you were to have bought, as Patrick was saying at the beginning of the year, the end of last year, and you're a believer, you're a long-term holder in Bitcoin, Ethereum, or whatever. Other token you might have, you can sell that and you can immediately buy it back. There's no wash rule in crypto, and you can realize that loss. And then the third thing is, we trade spreads, which anybody in this room can do that. I mean, Coinbase is a platform, not a great platform, but a platform that you can do it on. We look at Crescent City at our portfolio in a couple different ways. One would be, and obviously dollar terms, because that's what our limited partners look at it as. But also in Bitcoin terms. So the idea would be to obviously generate as much cash as you can, US dollars. But we also like to look at generating as much Bitcoin as possible. And so there's a lot of Bitcoin denominated pairs out there. Nearly everything on Bitcoin, on Coinbase, and Kraken for that matter, is denominated in Bitcoin. So look at things that tokens in a bear market. Look at tokens or other cryptocurrencies that have outperformed against Bitcoin. Think about look at what is this going to potentially come back against Bitcoin, since we are in this bear market. Bitcoin dominance is continuously creeping up, and then we can trade out of this token into Bitcoin, and then again, there's no wash rule, potentially back into the token at a later date. So I think that trading spreads is another good way to hedge yourself as a retail investor.
I think all three of those were exceptional responses, and I think something that no one anticipated at the beginning of this year was 3 cataclysmic events that kind of built on each other, right? So you had the Terra Luna event that happened, then you had 3RL's capital fell, and then you had basically multiple other institutions like Voyager and several others that kind of cascaded within that. And a lot of it had to do from over-leveraging in other ways. I even know someone who came on our show who was super bullish on Luna, sold all of their Bitcoin, Ethereum, Solana, put it all into Luna, and no longer exist. Going back to your example of why diversification is important. But nobody could have, at the end of last year, if somebody would have told you, hey, Bitcoin's going back to 18,000, you probably would have laughed at them. But here we are. How can people learning from these moments, begin to put strategies in place. So obviously you can always minimize your downside, but also be able to capitalize on the upside that's out there. And I'm gonna point this to Ian first.
How can people minimize the risk? So, I mean, I'll start very simple, right? So, one, begin with custody of your crypto, right? Don't put all your crypto in one wallet, on one exchange, and don't put all your crypto in one crypto asset, right? So, for example, like us with a fund, even if we're just in stablecoins, we have separate stablecoins across different exchanges, and we go through and vet each stablecoin to make sure this is something we want to hold on the books long term if there's a crash or if there's liquidity risk, right? Because that's something people in crypto don't really factor in. But as you mentioned before, there are lots of landmines in crypto, whether counterparty risk, whether liquidity risk, whether smart contract risk, whether getting hacked risk, right? So you have to factor in all these different risks and see how you can mitigate them, whether through DeFi insurance or even regular insurance, but just always try to see how can you mitigate the risk and make sure if a black swan event happens, if the worst possible thing happens, are you still protected? And if that is yes, then that helps you sleep better at night.
Yeah, I mean, my answer is also diversification. It's not just diversification in crypto. It's also diversification in your custody solution, whether it be a hardware wallet, Coinbase, Kraken. If you have $1 million in cash, you're not going to keep $1 million in one bank account because you're only FDIC insured up to $250,000. So you're going to keep your cash in different bank accounts. The same should apply to crypto. You want to keep it in different accounts.
Yeah. So I guess the way I would respond to this is, behave like an asset manager. So when we onboard a hedge fund at Blockfills, they read the fine print. They read the disclaimers. They know that if, for example, they're lending assets to us, that those assets are being rehypothecated to someplace else. Everything gets marked up and read and reread, and that's why it takes weeks or months to do anything. If David or Ian on board at Blockfills, do you think that if they're going to trade with us, they're just going to pile all their assets in first and then wait 6 weeks and then decide to trade? No, they're going to come to us and they're going to say, we want some credit, we want to understand your custody, we're going to put on a little trade and we're going to settle afterwards. Behave like an asset manager, read the fine print, understand counterparty risk. It's the number one thing you can do to protect yourselves right now. And of course, as individual investors, we are, we're more limited. We can't command the same authority as a large fund. But there are things you can do, just basic understanding of who your counterparties are. Take your crypto off the exchanges when you're not trading it. The things that these gentlemen just mentioned. But I think the number one thing to really consider would be, which is on everyone's mind going forward from this point on, is if you deposit assets somewhere, are those assets being lent to some other place? And if so, who's vetting those parties? Because that's how all of this went down. So I think the counterparty risk element is probably the most important element of this at all.
Just to tag back on that of reading the fine print, a lot of people didn't necessarily read the fine print around Celsius, for example. When you think about what is a bank, if you give a bank your money, they're basically giving them their money and they're promising to give it back. But they don't, they're FDIC insured now, so you're up to 250, so you're safe for that. In crypto, that doesn't exist. So what happened with Celsius when they over-leveraged and you couldn't get your money back was because they don't have a promise to give you that back. The fine print is, we're gonna get your money, we're gonna trade this money because we think we are smarter than you, make more money on that, and then give you these high yields as a thank you for lending us your money. So going back to the example of why you should be de-risking all this and looking out into the future. Of course, we all wish we had a crystal ball, we'd all be rich, but there's a lot of different macro factors happening right now in the world that have nothing to do with crypto. But then, of course, you have everything that is going on in the crypto space. What is your take on what the next 6 to 18 months look like? Well, 18 is probably too far. Let's just do 3 to 6 months. What do you think the next 3 to 6 months look like in the crypto space?
Want me to start with that? Sure. So one thing I will say about this is that, and this gives me a lot of hope and enthusiasm, is that after June was a stressful month for me. It was a stressful month for all of us, right? And as a company, we're wondering what's happening in the space. But we made some good risk management decisions. We didn't get wrapped up in a lot of this stuff that is in the news. And so when we came out of June, we were excited about what's gonna happen next. And the fact that some of our bigger competitors have had to pull back a bit because of some getting distracted by all the shiny objects out there. But the volumes are down, okay? We're a trading company, we look at volume. Volumes are down. But what hasn't gone down is the rate at which we are onboarding institutional clients. And I don't just mean hedge funds. I mean people in the payments business, gaming companies, other OTC desks and brokerages, companies around the world that are helping people get out of their crappy fiat currencies. The rate at which this is taking hold is not slowing down. And further, I know we don't like to talk about banks, okay, but for a proper market to exist, a real over-the-counter derivative market must exist. It exists in every other commodity on the planet. And we are gonna see, I think in the next year, we're gonna start to see major, big institutions, domestically maybe a little slower, but overseas much faster, engage in cash-settled derivative trading at an enormous scale. And that kind of adoption, once that happens, this thing is here to stay. So I don't know how quickly that's going to happen, but I do think within a year or so, we're going to start to see major participation at the third and second tier banking level globally, and that's going to drive adoption even quicker. And then eventually, when people figure out what's going on here in the States and the banks start to participate, then the train's left the station. So that's sort of my prediction for the next year or so.
So my prediction for the next 3 to 6 months, I'm still bearish, but in a good way, right? So in the sense that we're on the VC side, we're seeing valuations for startups come back down to reality, right? Startups that were trying to raise capital in the last 6 to 9 months are now repricing their rounds because now capital is hard to come by, especially after all the bearish sentiment in crypto, right? So on that aspect, very, very bullish on it. If you take, for example, projects like Polygon Network, right? Last cycle, you could have purchased Polygon on public markets for under a penny. It then went on to do over 400x, I believe. We went from under a penny to 270, right? And we're seeing now the same value on public markets as well, right? Lots of projects that have great technology, great communities, great ecosystems are down over 95% from all-time high, if not even more, right? So we think these projects, similar to Polygon, for the next cycle, will have those huge 100x returns, right? So in the next 3 to 6 months, we're basically going through, creating a watch list of crypto assets we think will bounce back and are still thriving right now based on data, based on fundamentals, and we think will drive the next market cycle. So my prediction is there's lots of value on public markets, and on private markets, companies are coming back down to reality.
So I agree with what they're saying. I'll tell you what we're seeing in the space is the same as Ian. We've seen valuations come down, but we've also seen money that was typically on the sidelines starting to be invested. There were, I think, the number is around $13 billion that was earmarked for crypto investments raised in cash in 21. A lot of those dollars were put to work at the beginning of the year. Second quarter, it slowed down. Third quarter, it really came to, beginning of third quarter really came to a halt. And now we're seeing those dollars being put to work again. So that I think from the venture side, from the project development, from the token side, from the building out blockchain, I think that that's I'm very bullish on that. Even now, over the next couple of years. But on the market side, I have a little bit different view. I think that all eyes are on the Fed right now. I've said this a million times. Richard's heard me say this a lot. And it's the Fed is between a rock and a hard place. I mean, they really don't have a good place to go. They either are going to fight inflation and continue to hike rates, or they're going to capitulate, and they're going inflation will be rampant, and the stock market should not suffer as much. And, the reason I say that is because we've seen over the last 6 to 12 months a real coupling to the equity market for the major crypto assets like Bitcoin and Ethereum. I believe that has started to decouple a little bit, but I don't think we're out of the woods by any means yet for the next 6 to 12 months. I think that we do have a ways to go, and hopefully the Fed will figure this thing out, pivot a bit.
Absolutely, and I think all of that. We're going to be recording a lot of this, and I want y'all to potentially go back and listen to it because there's just a lot of really good gems from what all of them said. And it's going to be interesting to see how the macro, I think, affects how cryptos continue to be received and being put out there. I think that a lot of crypto has been in conjunction with the macro, but right now it's kind of been in a side-by-side step, and I think that's going to continue to progress for a while. So I also think in the short term, things are looking pretty bearish. I think they could potentially, I don't think we've necessarily seen the bottom yet. I think we still got some we haven't seen max pain yet, but I think we are going to come out on the side of this. As the name says, AGMI, we're all going to make it, but I do think that not only just is Austin going to make it, but as you can start to do smarter trading, as you can start to learn from all the different ways that you can hedge and de-risk and look for certain opportunities, there's a lot of upside. And I think there's all the companies that are up here between Blockfills, Tokenmetrics, Crescent City, Acacia, they're finding ways to make sure that we all make it through these bearish times. So I want to say thank you to the panel. I want to say thank you to all for participating. And appreciate everybody's time.
Yeah. Thank you, Richard.
Thank you.
All right, so we're going to wrap up real quick. All right, so this has been the very first inaugural AGMI. Thank you all so much for being a part of this. I hope you enjoyed all of the amazing speakers and content we were able to provide for y'all. I hope y'all have been enjoying networking and meeting all the amazing people that are here. We're going to continue that. We have a lot of great things on the horizon, but first I want to start just by saying thank you to all the speakers. Another round of applause for all the amazing speakers that we had today. I think they all did an incredible job. And again, we did record this, so if you want to go back and listen and potentially share, you'll have the ability to do that.
Do you mind tapping that twice? So you should be seeing the sponsors up on screen, is that correct? Fantastic, because we need to owe them a huge thanks, right? So big shout out to, of course, title sponsor Cryptocurrent, but also our DGen donors, Curios and Howl, and our community catalysts who were instrumental for us as well, Acacia Digital Holdings, Crescent City Capital, SVG Capital. More time for me. And the people who actually informed you about it, right? Our media partners. So to Cryptocurrent, Howl, Wranglers, Blockfills, Crypto News, NFT Evening, Brave New Coin, Texas Blockchain, and WRST Collabs. We really do appreciate every single one of them for chiming in and helping us to make this event a reality. It's been really special doing this for you guys, and we look forward to hopefully hosting another event for you in the very near future.
Also, finally, I want to thank all the attendees. Without this, none of this is possible, so I really appreciate you being here.
Thank you for joining us for another episode of Cryptocurrent. Cryptocurrent is a cryptocurrency and blockchain education platform that's bridging the gap between the curious newcomers who are just discovering the space and the thought leaders who are shaping its future. All opinions expressed by Richard Carthon, the Cryptocurrent team, and their guests on this show are exclusively their own opinions. This show and any other Cryptocurrent production is exclusively for informational purposes.